Hi and welcome to TCM Education. So we're going to continue with our videos in our series Green Days library, and let's focus on a stock that is showing a huge gap up after a buyout or a takeover, let's call it. I'll talk about it in a minute, and then we'll see how the stock reacts and how sometimes those scenarios are always on the table. Big gap up can turn into a short trade. So who is our candidate today? We're talking about this company, GMS. 99.99% of traders never heard about this company. It's a company in the construction business, the distribution. It has distribution centers. They are dealing with ceiling and steel framings and stuff like that. Nothing that we know anything about, but Home Depot knows about this business, and they are taking over this company. That created a huge pickup in the price, up 24%, and a huge pickup in volume. You can see of over 5 million, and the percentage range is more than 5%, which is something that we love. We want to see 10%. In this case, it's only 6%. We'll see immediately how it affects the trade, basically. And now what can you do? I mean, the stock is opening up 25% higher. Is it a long? Is it a short? Let's take a look at the intraday chart and make our decision and try to learn from the price section of GMS. So that's GMS, the gap up of 25%. So immediately we can see at the open kind of a turmoil. Let's take a look at this area. Anywhere between 104 and 101. So you can see an array of bars in the first 20-30 minutes with the highs of the day at 104.50. If we're looking at 104.50, the stock actually breaks 104.50, goes up another 50-60 cents, and then starts to move lower. So after basically half an hour of trading, the stock starts to move lower. Actually, you know what? It had another spike up, but never moved over 105 anymore. And basically, since before 10:30, it started to slide and slide and slide. Basically, it had from 10:30, 5 hours. Where the stock moved lower. So maybe a little bit less, that's 5 hours where the stock topped at 105 and ended up at just above 100. So that is a $5 move lower. Now, what happens when you try to move against the trend of the stock? If you're lucky, it turns around with your timing. If you're not lucky, if you're unlucky and you're just thinking it's a long because it gapped up a lot, this is a big mistake. Now you have to look at the chart and decide if it is a long. It is a long here in the first hour of trading with this 104.50 breakout play, and it fails. I mean, it spikes up for 2-3 minutes, immediately turns back down. Again, it's clear that it's choking here. Now, can it move up $1 or $2 and then choke? Of course. Now, where are other entry points? Because I don't see anything here in this mess. Okay, and the stock is moving sideways. Okay, so you want to go long, of course, but at one point the stock is telling you, okay, I'm not moving higher anymore. And the clear area is here, probably around this 103.50 and definitely at 103. Once the stock breaks 103, you cannot make a distinction here. The stock is trending lower. Now, where can you enter the trade short? Because I assume that you look at this chart pattern and you think, too bad, it's up a lot, there is profit taking, and the stock is not turning around anymore. Hold on a second, let me add the view up. Okay. Okay, here's the VWAP. Let's see if it can help. Not so much. Okay, so let's say that you are observing this chart and you're shorting it at 103. The risk is to 104, so that's a 1% risk. Fits our strategy of 1%, no more than 1% risk reward. I'm talking about the risk here, so that's the 103 breakdown. This is the 104 stop loss. Maybe you can use another stop loss. I just don't see one at this point. That's debatable. What's not debatable is that 103 is a clear breakdown level. And it proves itself being that once the stock left 103, it just took a dive to 100 at the close. Now, where can you enter if you missed the 103 with very little risk? This consolidation here. We'll measure the cents in a minute. So short one under 102, or in this case 101.60. Let's take a look exactly at the numbers. So the lows of this consolidation 101.70. The highs of the consolidation 101, let's call it 10. So here it is. Let me bring it in. 101.70, and here it is 101.10. Hold on a second, why is it looking so ugly? Okay, sorry, it's a 101.10. A bit tough with this charting platform. Let's call it 101.70 and 102.10, of course. So that's roughly 40 cents of risk. Now 40 cents of risk is not 1% of risk, it's 0.4% of risk. Okay, so the risk on this move is 40 cents versus $1 on the move down from 103. Now, do you observe this trade? You like it? Fine. You don't like it? You don't do it. But I think when you're talking about a stock that's $100, the risk is 0.5%, 40 cents. There is a lot of potential here. You don't know if this stock is going to continue lower at $3 or reverse. Worst case scenario, you lose 0.5%. So we go back to our usual. If you're risking $20,000 per position, in this case roughly 200 shares, the risk is 40 cents, so okay, so you're risking $80. The maximum risk including slippage, let's call it $100. You're not going to risk 1%, which is $200. So it's definitely worth taking this trade if you observe it. The potential is here. Okay, so what happens next? Let's draw the line on the entry again. This is the entry, the red line. So that's a 101.70, and the stock closes basically at 130. That's roughly $1.40. Is it? Yeah, $1.40 on a 40-cent risk. That's nearly 1 to 4. Now, is it an amazing trade? No, it's not. But it fits the strategy. It lowers the risk on the trade, and let's call it what it is. It's a very good trade. Taking into account it's not coming early in the morning on Friday. It's late in the day. It's not an early entry, so it's like taking advantage of a very clean pattern that is drawing for us a very little risk. So again, the risk reward is 0.5% to whatever the market will give us. In this case it was 2%, which is nice. Roughly 2%, maybe a little bit less than 2%. That's how again you deal with stocks that are not fitting the strategy, which is a gap up and go. And again, you try to gap up to go with the gap up and go, you lose money. Okay, so how much do you lose? Worst case scenario, you have the 1%. You try this reversal play lower, So it's not a reversal play, it's more like a cup and handle. If I want to draw the line here, maybe I can draw and show you here even a cup and handle formation. Yes, you know what, I didn't observe it until now. It is somewhat a cup and handle formation. Okay, we'll take it. I mean, if you observe it, it's fine. I was just observing this consolidation between 102.10 and 101.70. That's the 40-cent consolidation. So that's what you have to deal with. And again, regarding the management, we have two options: to take the profits after 1.5%, covering the risk, or move the stop loss to the entry and wait. I think on all of the examples that I gave you, waiting paid. I have another example where I will show it to you in a minute, where waiting did not pay. Okay, so it's not like it's 100% of the time it's working. There'll be, you know, better days, and some days it will work more and some days it will work less. I think that over time, statistically, it's proving itself. Now, those who don't like to wait or whatever are rushing into taking profits, don't take profits, elevate your stop loss, lock profits. If you're lucky, it doesn't pull back to your stop loss, and you stay and you survive the trade. So because we still have a couple of minutes, let's take a look at OXO, another stock that ended up more than 5%, very good volume, and this is the intraday chart. So what's going on with OXO? You can see the gap up, the stock moves higher, and then let me take the disclaimer away. For whatever reason, it's refusing to move. Okay, here it is. Okay, so OXO gapping up, moving higher. Now, where you enter this trade, debatable. Okay, but let's say you enter this level here at 23. Let's call it the VWAP. You can use this 23.20 support, and you're entering 23.40 to 23.50, and the stock actually moves up $1. Yeah, however, what happens late into the close, you lose almost all of your profits because of the sell-off late in the day. So it can happen. There are no guarantees here. Sorry about that. So in this case, we can see this move up, move down, and then the second wave to the highs of the day. Now, where is the right place to exit? Probably here. Okay? And if you're waiting for more, in this case, you're going to lose most of your profits, so you're going to end up with 20 cents out of $1, which is shameful, but it can happen. I mean, sometimes you're going to get 50 cents in the last couple of minutes. Sometimes the market takes it away from you. I don't know what happened in OXO, and it's none of our business right now to analyze why, because it's so random, let's face it. Okay guys, video number 5. Hope it was illuminating enough and showing the various way the market is moving and the various way we can react and hopefully take advantage of trades up, trades down, all according to this built-in scenario, which is 1% risk, closing at either 1.5% in the money or at the close of the trading day. Thanks a lot for being here with us. Please share this video with your friends, especially those who are day trade. We'll see you in our next video.